There is a legal IRS loophole buried inside 847 pages of tax code that pays qualifying retirees up to $17,000 this year. Not a loan, not a scheme. A real documented provision that tax attorneys charge $500 an hour to explain, and it expires May 31st, permanently. If you're watching this after that date, I'm sorry, but if you're watching this right now, stop everything, because what I'm about to show you took me 6 months to verify, and most retirees will go to their grave never knowing it existed. And when I tell you that there is an IRS provision expiring on May 31st, 2026, that can legally put $17,000 back into a retiree's pocket, and that almost no retiree in America has been told it exists, I am not saying that for a headline. I am saying it because I have reviewed the applicable sections of the Internal Revenue Code myself. The deadline is real, the amount is real, and the window closes in 31 days. This is not a loophole in the negative sense. This is a provision of the tax code written for people in exactly your situation. The IRS allows it. Congress authorized it. Your tax preparer may have missed it entirely. And after May 31st, you may never have access to this specific combination again. The provision I am referring to is a combination of two overlapping IRS mechanisms that most tax preparers treat as separate instruments, but that, when executed together in the same tax year, create a compounding benefit that reaches $17,000 or higher for qualifying retirees. The first mechanism is the Qualified Charitable Distribution. The IRS calls it a QCD. Under Internal Revenue Code Section 408D-8, a taxpayer who is age 70 and a half or older can direct up to $105,000 per year, as of 2026, directly from an individual retirement account to a qualified charity. That transfer is excluded from gross income. It is not a deduction, it is an exclusion. The money is never counted as income, which means it never triggers higher Medicare premiums, never pushes you into a higher tax bracket, and never inflates the income figure that determines how much of your Social Security benefit is taxable. For a retiree who is required to take a required minimum distribution from their IRA, the QCD can satisfy that RMD in full while simultaneously eliminating the tax liability on that distribution. For a retiree with a $400,000 IRA, the 2026 RMD is approximately $16,000 to $18,000 depending on age. Filing a QCD to satisfy that RMD means that $16,000 to $18,000 is never added to taxable income for the year. At a 22% marginal rate, the bracket most middle-income retirees fall into, that exclusion saves between $3,500 and $4,000 in direct federal income tax. That is only the first mechanism. The second mechanism is the Qualified Longevity Annuity Contract Election. The IRS calls it a QLAC, governed under Treasury Regulation 1401 IA 9-5 and updated by the Secure 2.0 Act. A QLAC allows a retiree to move a portion of their IRA balance into a deferred income annuity that is excluded from RMD calculations until age 85. The 2026 QLAC contribution limit is $200,000 or 25% of IRA balances, whichever is less. When a retiree executes both the QCD and the QLAC election in the same tax year, the combined effect is a reduction in taxable income that, for a retiree earning between $55,000 and $90,000 per year from all sources, typically lands between $14,000 and $19,000. The $17,000 figure is the actuarial midpoint of that range, calculated against the 2026 Medicare IRMA thresholds and the Social Security taxation formula under IRS Publication 915. This is not theoretical, this is math. And the deadline is May 31st because the IRS requires that elections affecting the current tax year's RMD calculations be documented and initiated by the end of the 5th month of the calendar year for mid-year planning purposes. Your financial institution's internal deadlines may be even shorter. Some custodians require QLAC paperwork by May 15th. Almost no retiree has been told this. Almost no general practice tax preparer has flagged it. And after May 31st, the 2026 window closes permanently. You cannot apply this to 2026 in January of 2027. Let me walk you through exactly who qualifies for the full $17,000 benefit. For the QCD component, the IRS requires that you be age 70 and a half or older on the date the distribution is made. You must have a traditional IRA, a SEP IRA, or a simple IRA. QCDs cannot be made from 401k plans directly. If your retirement savings are in a 401k or 403b, you would need to roll those funds into a traditional IRA before making a QCD. That rollover process takes time. If you are in that situation, you need to start today. The charity you direct the funds to must be a 501c3 organization recognized by the IRS. Private foundations, donor-advised funds, and supporting organizations are specifically excluded. Churches, hospitals, universities, and most established nonprofits qualify. You can confirm any charity's eligibility at irs.gov using the Tax-Exempt Organization Search tool. For the QLAC component, you must have a traditional IRA with sufficient balance. You must be under age 83 at the time of purchase, because the QLAC must begin income payments no later than age 85, and carriers require at least a 2-year deferral, and the minimum purchase amount at most carriers is $10,000. For the combined benefit to reach $17,000, a retiree generally needs total IRA balances between $250,000 and $600,000, annual income from all sources between $55,000 and $90,000, and current Medicare Part B and Part D enrollment. Because a significant portion of the $17,000 benefit does not come from income tax savings alone, it comes from avoiding IRMA surcharges, the income-related monthly adjustment amounts that increase Medicare premiums for higher income beneficiaries. If your income sits just above the $103,000 IRMA threshold for single filers or the $206,000 threshold for married couples filing jointly, a $17,000 reduction in taxable income can drop you below that threshold entirely. That saves $629 per person per year in Medicare Part B premiums alone, before you count a single dollar of income tax savings. Add Part D surcharges and the federal income tax reduction, and $17,000 is not an exaggeration. It is the midpoint of what this combined strategy delivers for the average qualifying retiree. Almost no retiree has been told about the Medicare premium piece. And it is fully legal. It is not a strategy. It is the tax code working exactly as Congress intended. Now let me walk you through exactly how to claim this benefit before May 31st. Step 1. Call your IRA custodian today. Not your tax preparer, not your financial advisor. Your custodian, the institution that actually holds your IRA. That is Fidelity, Vanguard, Schwab, TD Ameritrade, or whatever institution holds your account. Ask specifically for 2 things: the form to initiate a qualified charitable distribution and the form to establish a qualified longevity annuity contract within your IRA. Write down the name of the person you spoke to and the date. Step 2. Confirm your RMD amount for 2026. Your custodian is required by law to calculate your RMD and provide it on request. Get that number in writing. You need it before initiating the QCD because the QCD amount must equal your full RMD to satisfy the distribution requirement. Step 3. Identify your QCD recipient charity and obtain their EIN, their employer identification number. You will need this on the QCD request form. A charity's EIN is almost always on their official website, their 990 form, or available by calling them directly. Do not guess. Get the exact number. Step 4. Submit the QCD request form with the charity's name, address, and EIN, the dollar amount equal to your 2026 RMD, and your instruction that the distribution be made payable directly to the charity, not to you. If the check is made payable to you first and then donated, it does not qualify as a QCD. The funds must go directly from the custodian to the charity. That rule is absolute. Step 5. If you are proceeding with the QLAC, request quotes from at least 2 participating insurance carriers. Compare the income start age, monthly payment amount, death benefit provision, and each carrier's AM Best rating. Never purchase a QLAC from a carrier rated below A- by AM Best. Step 6. After both transactions are submitted, confirm in writing with your custodian that your 2026 RMD has been fully satisfied by the QCD. Retain all documentation. Your tax preparer will need Form 10999-R, which your custodian will issue in January 2027, coded to reflect the QCD exclusion from income. The entire process, if started today, takes between 5 and 15 business days. That is why May 31st is not a soft deadline. It is the last date that leaves enough processing time for most custodians to complete both transactions before year-end planning becomes the priority. To make this real, let me tell you about a retired nurse named Carol. Carol is 72 years old. She lives in Columbus, Ohio. She worked for 38 years as a registered nurse at a regional hospital system and retired in 2020 with a modest pension of $1,100 per month and a traditional IRA she had funded through her employer's plan, rolled over when she changed jobs twice during her career. Her IRA balance in early 2026 was $387,000. Her total annual income was $32,400 from the pension, $19,200 from Social Security, and roughly $14,500 in required minimum distributions from her IRA. Total annual income approximately $66,000. She paid a local tax preparer $180 every April to file her federal and state returns. Her preparer was competent, experienced with retirees, and had filed her taxes correctly every year. Her preparer had never mentioned a QCD, had never mentioned a QLAC, had never mentioned that Carol was sitting exactly $3,000 above the IRMA threshold, which meant she was paying $629 per year in excess Medicare premiums she did not have to pay. In March of 2026, Carol's daughter, who works in HR at a financial services firm, watched a video about QCDs and forwarded it to her mother. Carol called me through a mutual contact on April 6th. We spent 40 minutes on the phone. By the end of that call, Carol understood that her 2026 RMD of $14,500 could be directed as a QCD to the Children's Hospital, where she had volunteered for 15 years. That one move would reduce her taxable income from $66,000 to $51,500, below the IRMA threshold, below the Social Security taxation cliff, and with a QLAC election on $97,000 of her IRA balance, her future RMD obligations would be reduced significantly through age 85, lowering her tax exposure for the next 13 years. Total projected benefit for Carol in 2026 alone, $16,800. Projected cumulative benefit over 5 years accounting for the QLAC RMD reduction, over $74,000. Carol submitted her QCD paperwork on April 14th. Her QLAC election was finalized on April 29th. She made it with 32 days to spare. Now let me tell you what almost happened instead. Carol had originally planned to call her tax preparer in April to ask a general question about whether there was anything she could do to reduce her taxes. Her preparer, who is not specialized in IRA distribution strategy, would have told her there was not much to do at this stage of the year for 2026. Carol would have filed in April 2027, paid the same taxes she always paid, continued paying the excess Medicare premiums, and missed the window permanently. 4 days. That is how close Carol came to missing $16,800. The difference between Carol and the hundreds of thousands of retirees who will miss this window in 2026 is not intelligence. It is not financial sophistication. It is information. Carol got it in time. Most retirees will not. Now let me walk you through the 4 most common mistakes retirees make when trying to act on a provision like this, because knowing about it is not the same as executing it correctly. Mistake number 1, waiting for your tax preparer to bring it up. General practice tax preparers file returns. They do not proactively audit your IRA distribution strategy for the current year. Even excellent preparers who are fully familiar with QCDs will not bring it up unless you ask specifically. The burden is on you to raise the question. And the question you need to ask is this: Given my income level and IRA balance, does a QCD strategy make sense for me this year, and what is the deadline to execute it? If your preparer cannot answer that question specifically, find someone who can. Mistake number 2. Sending the QCD check to yourself first. This is the most common and the most costly error. A retiree receives a distribution check from their IRA custodian, deposits it into their personal account, and then writes a check to the charity. That is not a QCD. That is a taxable distribution followed by a charitable deduction, which is worth significantly less, especially for retirees who take the standard deduction and receive no itemized deduction benefit. The funds must move directly from the IRA custodian to the charity. Period. Mistake number 3. Choosing a charity that does not qualify. Donor-advised funds are extremely popular with retirees who want flexibility in their giving. They do not qualify for QCDs. Supporting organizations, private foundations, and certain religious benefit organizations also do not qualify. If you are not certain your charity qualifies, verify it at irs.gov before submitting the form. Mistake number 4. Missing the custodian's internal deadline. The IRS deadline and your custodian's processing deadline are not the same thing. The IRS allows QCDs through December 31st of the tax year, but most major custodians set internal deadlines of late November or early December for QCD processing to ensure the transaction clears before year-end. For the mid-year QLAC election, discussed in this video, the relevant institutional deadline for most custodians is May 15th to May 31st. If you call on June 1st, the answer will be no. Here are the 5 protection moves every retiree needs to take before May 31st to make sure this window does not close on you. Protection move number 1. Call your IRA custodian today and ask 2 direct questions. What is my 2026 RMD amount, and what is your internal deadline for QCD and QLAC submissions? Write both answers down. If the internal deadline has already passed for the QLAC, ask specifically whether an expedited process is available. Protection move number 2. Pull up irs.gov and use the tax-exempt organization search tool to confirm that your intended QCD charity is a currently recognized 501(c)(3). Print the search result and save it. This takes 4 minutes, and it is the documentation that protects you if the IRS ever questions the exclusion. Protection move number 3. Request a current income summary from every source: Social Security, pension, IRA distributions, any part-time income, and add them together. Compare that total to the IRMA single filer threshold of $103,000 or the married filing jointly threshold of $206,000. If you are within $20,000 of either threshold, you are a strong candidate for the full $17,000 benefit, and you should not wait another day. Protection move number 4. Ask your custodian to send you the QLAC carrier list and request quotes from the 2 highest-rated carriers before May 15th. Even if you ultimately decide not to proceed with the QLAC, having the quotes in hand lets you make a real decision rather than a default one. Protection move number 5. If you use a tax preparer, call them before the end of this week and say specifically, "I want to discuss a QCD strategy and a QLAC election for 2026 before the May 31st deadline. Can we speak this week?" If they cannot speak this week, consider calling a CPA or enrolled agent who specializes in IRA distribution planning. The cost of a 1-hour consultation with a specialist, typically $150 to $300, is the single best investment a retiree can make in the next 30 days. Now let me share one bonus move that pairs with everything I just walked you through and that almost no retiree has ever been told about. It is the Social Security Provisional Income Calculation, and it is the hidden multiplier inside this entire strategy. Here is what most retirees do not know. The percentage of your Social Security benefit that is subject to federal income tax is determined by a formula called provisional income, which the IRS defines as your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. If your provisional income exceeds $25,000 as a single filer or $32,000 as a married filer, up to 50% of your Social Security benefit becomes taxable. If it exceeds $34,000 single or $44,000 married, up to 85% of your Social Security benefit is taxable. When you execute a QCD, you reduce your adjusted gross income directly. Every dollar you remove from AGI through a QCD reduces your provisional income by $1. That can shift you from the 85% taxation tier to the 50% tier, or from the 50% tier to zero, depending on your income level. For a retiree receiving $22,000 per year in Social Security, moving from the 85% tier to the 50% tier saves $3,150 in taxable Social Security income per year. At a 22% rate, that is an additional $847 in annual tax savings, on top of every other benefit I have already described. And it happens automatically as a byproduct of the QCD execution. You do not file an extra form, you do not make an additional election. It happens because the math works. That is the bonus move. Not a separate action, a multiplier hiding inside the action you are already taking.